Good afternoon and welcome to Finley Davies Pension Update webinar. If you have questions during the webinar, please type them in the chat area accessible in the hidden toolbar at the top of your screen. We'll address all submitted questions at the conclusion of the webinar presentation. This webinar is being recorded and the recording will be available on Finley Davies' website. You will receive a link to the recording as well as a link to the presentation slides in the next few days. Today's topic is complex, and our goal is to make it as easy to understand as possible. So let's dive right in. Our presenters this afternoon are Amy Gentile and Jill Leitner. Amy is a senior consultant and co-developer of our firm's proprietary software for benefit calculations and valuation reports. Amy develops exhibits for various plan design possibilities, prepares non-discrimination tests, and provides deterministic and stochastic projections. Jill is also a senior consultant, and she provides actuarial and employee benefits consulting and is responsible for overseeing actuarial valuations, forecasts, plan compliance, plan design, studies and strategies, benefit calculations, and government forms. I'll turn things over to Amy, who will kick things off.
Thanks, Lisa. We hopefully will be able to cover all this without getting too bogged down in the details, but we do have a couple things we want to cover today. The first one will be the update with the mortality assumptions, the projection scale that was just released in October. Next, we'll talk about the Bipartisan Budget Act of 2015, which talks about PBGC premiums and extension of the HATFA funding relief, as well as touch on the granular accounting methods that have been discussed recently. At the end, we'll be able to answer some questions if there are any. So to start off, we'll talk about the mortality, and I thought it would be helpful at first to do a quick review of what happened last year. In October 2014, the Society of Actuaries, or the SOA, released a new mortality table, the RP 2014. It was the newest mortality table that we have seen since the year 2000, which was the RP 2000 table. This table was based on an experience study utilizing data from 2004 to 2008. It excluded public plans and looked at over 10 million people. A result of the study was longer life expectancies than any of our previous mortality tables. With the release of the table, they released it in multiple versions. The first was the total data set, then they also included a white collar version, a blue collar version, and a disabled version. In order to categorize these different versions of the table, they utilized plans that had more than 70% of the specific designation, and the same criteria is suggested for individual plans when adopting the modified tables. Along with the table was a new projection scale, MP 2014. What was new about this projection scale was that it was generational, which is much different than our standard projection scales we've used in the past. It is more individually based when it's looking at future mortality improvements. So what we mean by this is that when we consider future improvements in mortality, we look at someone's actual birth date and retirement date. So for example, someone that's 60-year-old today will have a shorter life expectancy than when today's 40-year-old will turn 60. So what was the impact of using these new mortality tables? Well, as I said, we had increased life expectancies. These increased life expectancies then yielded longer expected cash flows. And of course, longer cash flows led to increased liabilities. An average increase in your liability to adopt these new tables was 4 to 11%. The actual increase did vary by plan based on the plan's demographics and your prior mortality assumptions. The older your prior assumption, the bigger the increase. Some plans also chose to adopt an alternative projection scale as opposed to the published MP 2014. These alternative projection scales led to a much less significant increase in your liability. As far as adopting the RP 2014 table, auditors were strongly encouraging the use of this table starting with all fiscal year ends ending after its release. This table is currently only applied for accounting, and it has not been required to be used. It has not been released for purposes of IRS funding requirements, PBGC premiums, or 417E lump sum calculations. We are anticipating to have tables released for 2017 for these purposes. As far as adoption of the new table, there were various methods. Most plans did adopt the RP 2014 table itself. Then when applying a projection scale, some of them did use the published MP 2014 table. Others chose to use a modified version of the MP 2014. Some adopted the Social Security projection scale, and then there were also other alternative scales that were used. There were also plans out there that chose to delay adopting the new mortality table altogether. So now we're a year later, and the SOA has released a new projection scale in October, the MP 2015. This release did not impact RP 2014 table at all. It's just a projection scale. So what's different between MP 2014 and MP 2015? Well, we have 2 additional years of experience that we're reflecting. And we also have lower future mortality improvements. Ultimately, though, we still have the same ultimate improvement scale of 1% that MP 2014 had. Now, when applying this new scale to RP 2014, there are some choices. The original published RP 2014 table inherently had a projection in it from 2006 to 2014 utilizing the MP 2014 scale. It's been discovered that this projection did not match actual experience. So some people adopting the new scale are actually going back and applying MP 2015 starting in 2006 forward, while others are just applying the MP 2015 starting today. Again, this new release did not mandate the use of these tables or the projection scales, and they are not to be used for IRS minimum funding, PBGC, or lump sum purposes. It is also important to note that we do anticipate getting yearly updates to these projection scales. So you may be asking, well, what does this mean for my pension plan? What should I do? Well, the generalized approach we've outlined here, it really depends on what you're currently using. If you currently have adopted the RP 2014 with the MP 2014 scale, we do suggest going to the new MP 2015 projection scale. You would expect to see a 1% to 2% decrease in liabilities, and you should also anticipate on adopting any future updates that may be released. If you choose not to update to MP 2015 at this time, it'll likely be hard for you to justify any updates to future changes in the scales. If you're using RP 2014 with some alternative projection scale, we suggest continuing with the alternative scale. It was justifiable last year for your plan, and there is no solid reasoning that it would not be justifiable anymore. Of course, you should discuss this with your actuary and your auditors to make sure it is still legitimate. If you do decide to adopt the new scale as opposed to your alternative, the impact on liabilities will vary based on the current scale you are using, as well as, of course, the plan demographics. The plans that chose to delay adoption of RP 2014 should consider adopting the table at this time with the new projection scale. Again, discussions with your actuary and auditor are encouraged when it comes to this decision. If you decide to adopt this new table and scale, you should anticipate increases of 6 to 9%, again, depending on your plan's demographics and your current assumption. I'll now let Jill talk about the Bipartisan Budget Act.
The Bipartisan Budget Act of 2015 is stated as being critical for avoiding a government shutdown for the next 3 years. It was signed by the President on November 2nd, 2015. Part of the revenue for this bill comes from pension funding relief, and its intent is to increase federal tax revenue. There are 2 main pieces of the new law that are dealing with pension plans. The first is the increase to the PBGC premiums. Congress has once again increased the PBGC premiums that pension plan sponsors will pay for maintaining their plans. This applies to both the per participant premium and the flat rate premium portions of the calculation. The second piece of the new law is the extension to the HATFA funding relief. This extends the corridor range of allowable interest rates for plan years 2018 to 2024. we will go into more detail on the PBGC premium increases. Under the current law, we have a scheduled increase through 2016, and beyond 2016, they're expected to increase based on the national average wage inflation increase. Now, with the new law, we have scheduled increases through 2019 and increase with inflation beyond 2019. So there are two pieces to the PBGC premium calculation. The first is the per participant premium, which is a flat rate times the number of participants in your plan. And you can see on the chart that is here that for 2015, the rate was $57 times the number of participants, and that was already expected to increase, or I should say scheduled to increase, to $64 in 2016. Now with the new law, we go all the way up to $80 in 2019, and then inflation after that. The second piece of the PBGC premium calculation is the variable rate premium, and there are two pieces to this variable rate premium. The first is a calculation of a percentage of the unfunded vested PBGC liability. So in 2015, the rate is $24 per $1,000 of underfunding. And then in 2016, this increases to paying $30 per $1,000 of underfunding. Then with the new law, it's scheduled to increase every year up until 2019 when you're paying $41 per $1,000 of underfunding. And then the increases after that are just due to inflation. The second piece of the variable rate premium is a cap that applies to the number of the participants in your plan. This portion actually did not change with the new law. It currently is $418 times the number of the participants in the plan, and it's scheduled to go up to $500 times the number of participants in the plan in 2016, and increase just after that with inflation. Because this cap did not increase, any plans that were poorly funded that were already hitting this per participant cap are not going to see an increase in the variable rate premium portion of their calculation. So what do these increases mean for the future? Employers are going to start to look at their PBGC premiums to determine a funding strategy instead of just looking at their minimum contribution requirement. The PBGC premiums will start to play a bigger role in determining how much to contribute to the plan on an annual basis. Employers are going to start to look at ways that they can reduce their premiums. One way to reduce the premium is to contribute more to the plan, or simply take contributions that have already been made to the plan for another plan year and reallocate them to the current plan year, and this will reduce the underfunding of the plan. So for example, in 2016, if you're looking at the 2016 PBGC premium, it's based on 1/1/2016 assets and liabilities. If you take any contributions that were made in 2016 and reallocate them and call them 2015 contributions, then they can be added to the 1/1/2016 asset value and reduce the underfunding of the plan. You just have to be careful that you are also making sure that your quarterly payments are satisfied for your 2016 plan year. You don't want to take more contributions away from 2016 than what you're allowed to take away. Also note that there's no impact to the variable rate premium by reallocating contributions if you hit the participant cap, since that portion is just based on the number of participants in the plan. Another trend we are going to start to see is an increase in the number of deferred vested buyouts and retiree annuity purchases. By doing this, you decrease the number of participants in the plan and you decrease the per participant premium, which is up to $80 times the number of people who are cashed out is your potential savings. By doing this, you have little to no impact on the variable rate premium unless, of course, you do hit that participant cap. And if that cap applies, then there actually is a large decrease in the variable rate premium because you're saving that $500 per participant cap plus the $80 flat rate premium. And this is a savings year over year because the number of participants is reduced. So you'll get a savings every year by cashing out your participants. Next, we're going to walk through an example of how you can reduce the underfunding of your plan by reallocating contributions and how it can reduce your PBGC premiums. If you look at the first column, we have a plan that has a vested premium funding target of $150 million and market value of assets of $140 million. This plan does not reallocate any contributions to the current plan year. So the market value of assets that you're going to use in your calculation is the $140 million. Then to calculate your unfunded vested benefits, you take the difference between your funding target and your market value of assets, and you get $10 million. Then the variable rate premium, based on the $41 unit in effect in 2019, is simply $410,000. Now let's take the same plan with the same $150 million funding target and the same $140 million market value of assets. But now we are going to take contributions that were made after the end of the plan year, and we are going to reallocate them to the current plan year of $1.25 million. Once we discount those contributions back to today's date, we add them back to the market value of assets and get a total assets of now of $141 million. That reduces your unfunded vested benefits to $9 million, and your variable rate premium goes down to $369,000. So this is a savings of $41,000 in your PBGC premiums. Essentially, you did not make any extra contributions to the plan. Your savings are strictly due to reallocating those contributions to the prior plan year. The second piece of the Bipartisan Budget Act of 2015 is an extension to the HATFA funding relief. First, in 2006, we saw the Pension Protection Act of 2006, also known as PPA. This is where we were introduced with a three-segment rate approach, which is the average of the corporate bond yields over the last 24 months. Then in 2012, we had our first set of funding relief, the Moving Ahead for Progress in the 21st Century, or MAP 21. This set a corridor around the PPA rates based on 25-year average of the Treasury interest rates. These scheduled increase in the corridor from 2012 to 2016. So what this does is it translates into higher interest rates, which then produces lower liabilities. Then in 2014 came the Highway and Transportation Funding Act, also known as HATFA. This extended the scheduled corridor for 5 more years until an ultimate rate was reached in 2021. Next, we have the Bipartisan Budget Act of 2015, which extends the corridor even further. It extends it for 3 more years, and your ultimate rates are reached in 2024. All of this is good news because it means higher rates, lower liabilities, and lower contribution requirements. Now to dive into more detail about what these interest rates mean, on this next page is a chart that graphically shows the impact the corridor has on the original PPA segment rates. You will see the dark black line in the middle of the chart. Those are your PPA rates, your Pension Protection Act of 2006 rates, which is the 24-month average of your corporate bond yields. Those are the rates that we're supposed to use to value pension liabilities. Well, in 2012, when MAP 21 came along, it said we're going to look at the 25-year average of the Treasury interest rates and apply a corridor to that. So that's the entire shaded area, the orange and the blue area that you see up above. So these corridors look at, or they're set to be 10% for 2012, 15% for 2013, and grading up to a 30% corridor for 2016. So you will see that the black PPA line crosses into the shaded area in 2018, and that is where we expect the PPA rates to start applying again. Before that, the MAP 21 rates applied, but then starting in 2018 is where we would expect to see the PPA rates apply again. Then in 2014, when HATFA came along, it extends that 10% corridor out for 5 more years. So now we are looking at the orange shaded area of the graph, and you can see that we have a narrower band of interest rates and higher interest rates that are applying. Then that band of interest rates increases starting in 2018 and going out to 2021. But again, if you look at that black PPA line of interest rates, we expect it to cross into the orange territory in about the year 2020, when we see that PPA rates will start to apply again. Now, with our new law in 2015, it extends the corridor out even 3 more years. So that shaded area in orange with the black stripes over it, that area of the interest rates goes away, and we now again have a narrower section for our interest rates that apply to our liabilities. And now we see that in 2022 is where we expect the PPA rate to apply once again. So what does all of this mean in the short term? It means that we have higher interest rates than what we would have originally had under PPA. And these higher interest rates produce lower liabilities. In the end, you can see that we'll be at the same place as we were before, but in the short term, we can take advantage of this funding relief. Now let's look at a numerical example of how this corridor impacts the plan's liabilities and the minimum contribution requirements. This is the same plan at a snapshot in time. We're just looking at different interest rates which apply based on which corridor we are looking at. So in our plan, we have an actuarial value of assets of $26.6 million. And our funding target varies from $27.6 million under the 10% corridor scenario up to $33.8 million under the pre-MAP 21 scenario. So now we have the same plan with the same data and the same promise to pay benefits. And the only reason our liability is changing is because the interest rates that are used, that are dictated by the corridor. This translates into a one single effective interest rate for the plan of 6.08% in the 10% corridor, down to a 4.29% under the pre-MAP 21, which is a swing of 1.8%. In this plan, across the board, we have a pre-funding balance of $2 million. And we have a funding shortfall, which is the difference between your funding target and your actuarial value of assets minus your pre-funding balance, ranging from $3 million in the 10% corridor scenario all the way up to $9.2 million in the pre-MAP 21 scenario. So you can see this big swing, and just because of the corridors, how it is affecting your funding shortfall. Then to equate that funding shortfall to a percentage, the funding percentage of the plan, otherwise known as the FTAP, decreases from 89% down to 72%. And this funding percentage you can look at to determine if your plan has any benefit restrictions or if your plan is potentially in an at-risk status. 80% is the threshold. So based on which corridor you are looking at, you will see that under the first 2 corridors, these restrictions do not apply, but under the second 2 corridors, you're potentially in a restricted status. Next, we have the normal cost, which is the amount that the benefits are expected to increase over the next year, plus the plan expenses. This also changes as the interest rates change and goes from $500,000 up to $580,000. Next, the shortfall amortization charge is a 7-year amortization of that funding shortfall that we had calculated up above. And that increases anywhere from $500,000 under the 10% corridor scenario up to $1.4 million under the pre-MAP 21 scenario. And finally, you can see the impact that this has on our minimum required contribution. So if we're under the 10% scenario, we have a $1 million contribution requirement. Under the 20% corridor scenario, $1.3 million. Under the 30% corridor, $1.7 million. And all the way up to $2 million when you're looking at the pre-MAP 21 scenario. So your minimum contribution can double depending on what corridor is being applied to the rate. So what does this all mean? What are the pros of this pension funding relief? As we discussed earlier, these higher interest rates will decrease liabilities and reduce your contribution requirements in the short term for the years 2018 and potentially up to 2024. Because the minimum required contribution is lower, if you continue to contribute at the same level that you were contributing before, you can now build up these pre-funding balances and use them as offsets for your future requirements. Because you now have lower liabilities, you will see higher funding percentages for the plan, which means, like we saw in the example, that you can avoid benefit restrictions and you can also avoid at-risk status. And some plans that are under benefit restrictions will have a reduction in their Section 436 contributions. This is a contribution that's required to get your plan out of a restricted status. Some plans will also be able to eliminate the shortfall amortization basis if their funding percentage is high enough. Now, what are some of the cons of this pension relief? Ultimately, this is just a pension plan Band-Aid. The underfunding of the plan is still the same as it was prior to the relief. You're simply just changing the plan funding into a pay later instead of a pay now kind of a situation. Either way, you have to fund the plan. Because less contributions are going into the plan, you're also going to see a decrease in your actual value of assets. There are other areas outside of contribution requirements that are affected as well. Some plans that have restricted form of payment may no longer be restricted, and they will have to lift those restrictions and offer lump sum payments again. Your accounted funded status can suffer. It will be lower because your assets are now lower. And your PBGC premiums will increase, not only because of those automatic increases that we discussed earlier, but also because your assets are lower from contributing less to the plan. So is this pension relief a good thing? Many plans will continue to contribute above their required contributions to keep funding their plans. The only way to get yourself out of underfunding is to contribute to the plan. But now you do have a choice. You can either pay now or pay later. I'm going to turn it back over to Amy to discuss the new granular accounting methods.
Okay, well, for the accounting method, what I'll be talking about is how to determine the service cost and interest cost components of your pension cost. To start out with, I thought I'd go over the current standard method used by most actuaries and plans today. The current method is an aggregated method, and this process selects a single discount rate that is used to develop these service cost and interest cost numbers. And how this rate is determined is by taking the yield curve spot rates and matching it up to the plan's expected cash flow. We combine those two results to get a single present value today, and then we determine an equivalent single discount rate that would give us the same present value. We then use that equivalent single rate to not only determine the liability, but also to calculate the service cost and interest cost, and then ultimately the plan's pension cost. So what are the implications of a method like this? Well, using a single rate does cause the service cost to be overstated. The reason for this is because your service cost is based on the expected accruals for the year for your plan, and majority of these accruals are for the younger participants, so it's a young age. But our single rate that we're using is actually based on an older average age. So the single rate is lower than what the yield curve would actually produce for these accruals based on when they'd actually be paid out. The interest cost then is understated. The interest cost is supposed to accumulate the PBO from the beginning of year to the end of year, but under the aggregate method, the single rate doesn't recognize the fact that these payments are aging during that time period. The reality is, by the end of the year, the duration on these payments is shorter, and if we were to redetermine the discount rate, it would be lower than what we are using. The scale does balance out, though, if some conditions are met. If our new accruals that we're valuing in the service cost make up for a shorter duration that we're experiencing in the demographics of the interest cost, then we balance out. We would also balance out if our end-of-year discount rate ends up equaling our beginning-of-year discount rate. There are some pros and cons, of course, to this method. Some of the pros are The first one is simple. It's simple and straightforward. It's very easy to explain and understand this aggregate method. And then if your discount rate remains level, you don't experience any end-of-year gains or losses. The other pro is that there is a reduction in volatility. We're using a single rate, which smooths out the demographics and the results. Some of the cons for this method is that the calculation is more of an approximation. It's a single rate based on the average entire population, so it's not a very precise calculation. The discount rate is much more sensitive to changes such as demographic swings or plan amendments. And if you're a plan sponsor that needs to break your pension costs down between different groups or divisions, the split between the separate costs that go in, the separate components that go into your pension cost is not as clean of a breakdown under the aggregate method because of the average demographic process for determining the discount rate. We also do have some reliability that our demographics are going to stay stable throughout time. This is because we are looking at an average of the demographics that we are utilizing for the calculation. What are some other alternatives that people are talking about now? Well, the new methods are called granular methods. The one that I'm going to talk about right now is the individual spot rate method. So we are no longer looking at a single discount rate for these calculations. We would still calculate our liability the same way we did before by matching up the expected cash flow and getting a present value. But now when we go to calculate our service cost, we will not use that same equivalent single rate from our liability cash flow. We would instead match the yield curve spot rates up to the cash flow that is expected to accrue from the actual accruals represented in the service cost. So the benefits that will be earned in the coming year will be matched up to the future spot rates when we expect them to be paid. We will then take the total of all those years of service cost components, and that would be our service cost we use in our pension calculation. For interest cost, it would be a similar calculation. We would match up the yield curve spot rates to the expected cash flows and determine the interest cost for each respective spot rate, and then total them up to get our interest cost. The underlying assumption for this method is that each spot rate is attached to an individual cash flow. So we're assuming that the rates are going to shift as the cash flow matures. And it's important to note that this method always affects interest costs more than it affects the service cost. There are other alternatives that are available, but currently the SEC has only approved this individual spot rate method. So if you were to implement this granular method as opposed to the aggregate, what would be the impact on your plan? Well, on the chart in front of you, you can see we have some results that are from the American Academy of Actuaries based on a December 2014 analysis of the yield curve. I have shown the results for the various different granular methods that you can use, but I'm going to focus on the spot rate method that I just discussed. If you were to go to the spot rate method, for service costs, which I mentioned was previously overstated, you would see a drop of roughly 5 to 6%. This is because our spot rates are now better reflective of the age associated with the accruals that we're valuing. Our interest cost, which was previously understated, will go down roughly 13 to 15% because we are now better matching up the duration of each of our cash flows. The combined impact of the service cost plus interest cost would be a decrease of roughly 8 to 11%. The total impact on pension costs really depends on the plan itself, depends on the gain loss, the amortization period being used, if any, and also on the duration of the plan, because a shorter duration does result in a larger impact with the granular method. So now we can look at the pros and cons of the granular method. So some of the pros are that it's much more accurate overall. The service cost is much more accurate because we're looking at the individual accruals with the associated ages. We don't have that dependency on the stable demographics since we're looking at, again, the individual cash flows. And if you were to break down your components of your pension cost, it's a much cleaner breakdown between divisions and groups. Some of the disadvantages is that it is much more complicated. It's a lot harder to explain. You have less transparency You're now utilizing multiple rates, which you will need to disclose all of these rates in your results. And a key thing is that in order to avoid any experience losses at the end of the year, this method really relies on discount rates increasing through the course of the year. We do see an increase in volatility as well, since we are basing it on an individual approach instead of the aggregated. And one of the big things is that settlement costs will increase. Settlement costs are associated typically with lump sum distributions, and a settlement charge is required at the end of the year if your lump sums are higher than your service cost plus your interest cost. Well, we are saying that we're going to be decreasing the service cost plus interest cost, so therefore it will be easier to incur a settlement charge. So plans that previously had avoided these charges may no longer be able to avoid them, or plans that already experienced these charges may have larger charges at this time. Other implications are based on your current pension cost approach. If you're using a mark-to-market method, which is an immediate recognition, your annual cost won't really change from the aggregate to the granular. Your service cost and interest cost will decrease, but this decrease will then shift to your end-of-year recognition in your gain loss. If you're using the corridor method, which is where you amortize your gains or losses each year, your current costs will decrease, but future costs will most likely increase as you're deferring gains and losses down the road. So now you're probably wondering, well, is granular accounting right for my plan? Well, it's important to think about the items we just discussed. Are settlement charges an issue for your plan? Are they a concern? Do you pay lump sums or intend to? Or are the large accounting charges at the end of the year something that is an issue for your organization? Are you willing to sacrifice the volatility just so you can have an immediate reduction in pension costs? And do you split your pension costs across multiple groups and would prefer the cleaner approach to splitting it? So the granular method, while it does get more accurate and it is less of the approximation of the aggregate method, there are some downfalls. It is more of a, reduce your costs now, you'll pay them later. It's important to remember, your plan still costs the same. So whether you pay it now or later, in the end, you will have the same costs associated with the plan. Jill and I covered a lot. So to real quick, we just wanted to summarize what plan sponsors should take away from what we've talked about, what they need to think about and discuss. You need to consider if you need to update your mortality assumption. Where were you at with your current assumption, and where should you go? What are ways that you can reduce your PBGC premiums now that we have another round of increases implemented? Should you develop a funding strategy if you don't have one, or if you have one, does it need looked at again? Is it worth taking the cash contribution reductions now, or should you continue to contribute at the current level and look forward to reductions later on? And can your plan benefit from these granular accounting methods? Are they right for you? These are all questions you should present to your actuary, discuss them, and make sure that you proceed accordingly with what your plan needs are.
All right, we have covered quite a bit today in a short period of time, and I see we have a couple of questions. So we have a few minutes here. The first question is, can you purchase lump sums for retirees to reduce PBGC premiums?
I'll answer that one, Lisa. Unfortunately, it is no longer allowed to purchase lump sums for your retirees to reduce your PBGC premiums, or I guess I should say just to purchase lump sums for your retirees. I know some large companies a few years ago did this, but a notice has come out, Notice 2549, which eliminated buying lump sums to replace retiree annuities. So unfortunately, it's not allowed.
All right. The next question is, when should I discuss mortality assumptions with my auditor?
It's a good question, Lisa. Really, I would suggest talking about it sooner rather than later. At least a month before your fiscal year end, the conversation should be started so a decision can be made early on.
Okay. Next one is, will the interest rate relief impact my PBGC premium?
No, it will not impact your PBGC premiums. Your PBGC premium liability is based on the rates prior to any funding relief. So it is based on those original PPA funding rates and is not impacted by any of the pension relief legislation that came out. So unfortunately, this will not help your PBGC premiums.
All right. That's all the questions that we have submitted. And I would encourage you to feel free to call or email Amy or Jill if you want to talk in more detail about some of your specific questions. And thank you for joining us, and this concludes the webinar.